morning and welcome to the 120th episode of the Veritas fact-finding series. And today I'm joined by our special guest, Professor Campbell Harvey. Good morning, Campbell.
Morning.
In each episode of our fact-finding series, we go on the ground to speak to industry professionals in an unscripted, candid, live video format to discover how we can make better investment decisions. In this series, and with everything we do, we believe the facts empower investors and that better information leads to better investment decisions. If you're watching and you like what you hear, give us a like and follow us at www.veritascorp.com. By way of background, my name is Anthony Scilipoti and I'm the president and CEO of Veritas, which is an independent equity research firm based in Toronto, Canada. And I'm proud to say this year we'll be celebrating our 24th year being 100% employee-owned and operated. Quick disclaimer, this broadcast is not to be taken as investment advice, and participants and/or employees of the Veritas group of companies may own securities discussed in this broadcast. And while we love all our guests, and Campbell in particular, this session may contain forward-looking statements, investment opinions, and comments that we may not agree with at all. Now, I'm going to find that hard to believe in this discussion. But now I'd like to tell you a little bit about Campbell. And I know Campbell in the intro of this, he said to me, listen, don't read out my intro because people can read that on their own, and that's true. He's won numerous awards. And I think it's interesting that those are recent. They're not awards that stem back from when and we're going to dig into that, from when he's been when he came up with what he's most famous for, perhaps, is the inversion of the yield curve and its predictability to what's going to happen in the economy. But he actually began at the University of Toronto, just like yours truly. He's published over 170 scholarly articles, as well as a number of books. And his expertise and commentaries span numerous topics, including active investing, risk management, emerging markets, behavioral finance, financial econometrics, and computer science. And one thing that I think we need to point out, which we're going to touch on during our discussion, is DeFi. And he's written a book called DeFi and the Future of Finance, which you have to hang on to and make sure you're aware, because that ties into AI and everything that we're experiencing today in the current markets. Now, Cam, as we do with all our guests, and it's most important, I'm going to ask you, how did you get your start? Why do you do what you do? And what makes you tick?
Well, a lot of this is just random. So I'm a student, as you mentioned, at the University of Toronto at Trinity College.
Yeah.
And I'm doing okay. I'm studying a very diverse set of topics. Indeed, I didn't do a single business course. So I'm a professor at a business school, and my undergrad had zero business material. So after that, I wasn't really sure what I was going to do. Maybe law school, maybe business, but I ended up at doing a master's degree in business. And kind of the story as to how I got started happened during an internship. So after my first year of my master's degree, I had a couple of opportunities for internships. Both of them were in corporate development. And I chose one at a company that doesn't exist in the name, at least. And it was called Falconbridge Copper. And at the time, the largest copper miner in the world. And that was kind of attractive to me. So I showed up and I was given literally one task. And it was a very exciting idea. And I was told that I needed to develop a model to forecast real GDP in the US. And in real time, I'm thinking, oh, wow, that's great. It's a real honor to be asked to do something like this. after many years of considering it, I realized how ludicrous it was. So think of this, that we all know that copper moves with GDP.
Not
So
the other way
the,
around.
the single most important input for planning at a copper miner is having some sense of what GDP is going to do the next year. They call it Dr. Copper for a good reason. So think about the decisions in terms of closing mines, opening mines, development. All of this stuff is tied to the economy, and they need to have a forecast. So what do? They assign it to the intern. So again, I didn't think that way way back when I started this job. But when I thought about it, like I knew that there were alternatives. So at the time, there were three major econometric forecasting services that you subscribed to them and they would deliver a forecast. And this was very expensive, way more expensive than what they were paying me in the summer. And it was about $250,000. And these companies had massive models. Think of hundreds of equations, teams of econometricians and statisticians, and the best quality data that money could buy. So there's no way that I could compete against something like that. I didn't have the data, I didn't have the computing resources, and I certainly didn't have a dozen econometricians to call upon to build in short order, in a matter of weeks, a model. So I had a different idea. So during my first year, I read a couple of papers from somebody at the University of Chicago, Eugene Fama, and he was making the case that there was valuable information in stock prices that is relevant for kind of future economic growth. And he made a reasonable economic argument. And the idea is that the earnings or the cash flows of companies are highly correlated with the health of the economy. So the economy is booming, then earnings are expected to be high in general. So given that the stock price represents the present value of all those cash flows, that the stock price today should capture expectations of future economic growth. So I thought this was a great idea, but I also read his papers, and it turned out that, well, the theory made sense. Empirically, it didn't work. The stock market was very volatile and was giving like a lot of false signals. But that idea that the asset prices reflect expectations of future growth, that idea stuck in my head. And I said, well, maybe he's looking at the wrong asset. So I thought, what about looking at bonds? So in particular, treasury bonds. And there's so many advantages to looking at bonds. So number one, they're relatively risk-free in terms of default. Number two, you've got a maturity. So a stock doesn't have a maturity. Number three, you've got a coupon that you know. So with the stock market, you've got dividends, and who knows what they're actually going to be in the future. So it just seemed like a much better asset to look at. And I did preliminary work, in particular looking at a series of interest rates or the yield curve or term structure, and it looked really promising. So it looked like the slope or the difference between, let's say, a longer-term bond and a short-term bond, that was highly predictive of GDP growth. So I'm very excited about this idea, and I was going to present it to senior management at Falconbridge when I showed up at the office one day and was told that the entire corporate development group had been terminated. So I'm out of a job. And at the time, it was a disaster. There's no way I could find like another job for the next 4 weeks. And it seemed really harsh. Like to ditch the intern, like maybe you might expect something like that to happen in the US, but I thought Canada was different, a little friendlier. But no, I'm out on the street with no work. And it turned out because I decided to continue to pursue the project. I was really engaged in it. I thought it was exciting. And when I got back for my second year, I showed my research to one of my mentors in the master's program. He looked at it and said, "Oh, this is very interesting. You should develop this. We'll give you credit in terms of a term paper. I want you to push on this." And I did. I pushed on it in the fall and I showed it to him. He circulated amongst the faculty and he gave me advice that this is the sort of research that should be pursued in a PhD program. And I had no idea. So I was not thinking a PhD. I was thinking of getting like a regular job. Indeed, I was the first one in my family with a bachelor's degree. And I'm kind of pushing it to go for a master's degree. And I remember my grandfather, when I told him that I was going to pursue a PhD, he said, "Well, is that one extra year?" No, that's not the way it works. And there's a lot of family pressure to kind of go into business. They just didn't have the familiarity with the academia. So I applied to many places, but my top pick was the University of Chicago because that's where Eugene Fama was. And he was the one that influenced my thinking. And I was accepted at Chicago in hindsight. When I look at the applications to PhD programs today, in hindsight, my application was a good application because it wasn't just the grades and your test score. I was actually showing an interest in research. I enclosed a paper as part of my application. I said, "This is what I can do." So I got to Chicago, and the usual way it works at any PhD program, you do coursework for at least 2 years, and then you start working on a research project. Well, for me, it was different. I actually showed up at Chicago with the idea. So day one, I was working on my dissertation, and it was great because I had this idea, and the courses really fed into the idea. So when I'm doing my coursework in micro and macroeconomics and asset pricing and things like that, I'm thinking about how the coursework actually fits in to this insight in terms of the slope of the yield curve being very predictive for economic growth. And I did put the dissertation together. There was, of course, some that were skeptical. And if you think about it at the time, I'm looking at data from the 1960s to the 1980s, there weren't that many recessions. It's only like 4. And more than one remarked, "Well, you might just have a lucky finding." So there were 3 factors that kind of convinced my committee. So number 1 was the solid economic foundations. So this is basic stuff that people agree upon. Think about an interest rate. So an interest rate has got 3 components. So number 1 is expected inflation. Number 2 is the expected real interest rate. And number 3 is a risk premium. And let's forget the risk premium right now, given we're talking about government bonds, and focus on that expected real rate. In almost all of the models that we have, that expected real rate is linked to expected growth in the economy. So the model was very natural. It was easy to look at my empirical finding that the yield curve inverted before recessions and link it to the theoretical framework and say, well, that's what we would expect. We haven't looked at it from this dimension, but it fits the basic economic theory. Number two, that the model was a simple model, and simplicity is important in any sort of modeling. That once you get too complex, then there's data mining and overfitting and stuff like that. So that was attractive also. And then I remember one of my committee members, and it turned out that Eugene Fama was my dissertation chair, later was awarded Nobel Prize, actually.
Yep.
And actually another Nobelist on my committee, Merton Miller, liked something really that I hadn't thought about, that my model was competitive or outperformed these econometric services that were charging $250,000 a year. And he said something in the seminar, something like, well, I like your model because instead of paying $250,000 a year, I just need to pay, at the time, 25 cents for a Wall Street Journal. That's it. So my forecast, 25 cents. So there you go. I actually get approval for the dissertation. I end up at Duke University, very lucky to get to Duke because the head of the finance group at the time was Douglas Breeden, who was one of the pioneers in this field of asset pricing that is very much linked to kind of the theory behind my model. So it worked out well for me, and I pursued this research for a number of years before moving on to many other things that you mentioned.
So if we take that to the current day, well, and I actually want to ask you, so why is it then? I mean, there's many things you could do with the amount of information that you've accumulated, its predictability, and I want to congratulate you. You have received a significant amount of fame as a result of this, and yet you're working as a professor. You wear numerous hats as a research head. Why is it that you decided to take this route?
Well, I think it's fairly simple. I didn't know that I was going to be a researcher, as I mentioned. But once I got the research bug, once I made that discovery as like an intern, that was just like really a lot of fun. And I realized that this was a finding that had significant implications for the practice of management. And that's really what I like to do. So I've been very fortunate. So yes, I do have an appointment at Duke University, and I've been at many other universities, but I began at Duke and I'm there right now. But I also have the luxury of being director of research and partner at research affiliates in Newport Beach, California. I'm investment strategy advisor at Men Group, based in London, and that's the largest listed hedge fund in the world. And I have this luxury of interacting both with academics and with practitioners. And when I say practitioners, I don't just mean asset managers and consultants. I mean interacting with the asset owners, the pensions, the very largest pensions in the world, the sovereign wealth funds. I talk to them and I ask them, what are the most difficult problems that you're grappling with? And for me to identify what's actually needed gives my research direction. So the research that I want to do is the research that has the maximum positive impact for the practice of management and the economy in general. So yeah, you're right that I could make more money if I was exclusive at a company, maybe on Wall Street or wherever. I can make more money, but I guess I operate differently, that I get a lot of benefit, personal benefit from exploring ideas. And when you're a professor, it you're not competing against fellow professors at, let's say, Duke University. No, you're competing against everybody in the world. And in my field, that includes not just universities, but companies, nonprofits, multilateral organizations. Everybody is a peer, and you are in the business of competition for the best ideas that have the maximum impact. So that's what energizes me and continues to energize me. And I do think, again, I'm fortunate to have this ability to talk not just to fellow academics, but beyond. I think that over the last maybe 20 years, many business schools have drifted away from doing research that is relevant for the practice of management. My research, in my opinion, I'm trying to state this humbly, I try to make it relevant. I want it to be used. And indeed, that's the goal. Like, not the goal just to write a book or to get published in some scientific journal. I actually want this stuff to be used. And the yield curve work is a very good example of that. That is being used, and that is useful. It took a long time for it to get kind of accepted. It was under the radar for so many years and ignored for so many years. But it was only after the global financial crisis that people realized that, oh, this indicator is 7 out of 7 over the last 50 years. So we need to take it seriously. And indeed, it is taken seriously today. And this is a kind of a good example of kind of the benefit. So to have that idea of what might happen to economic growth is very important for planning, for risk management. So after the global financial crisis began, you can imagine a CEO getting in front of shareholders and explaining the large loss that the firm made, and said, look, we had no idea this was coming. We had no idea. Indeed, it's not just us. Look at our competitors. Everybody got whacked. This was a surprise. So don't blame me. It is just a surprise. And then imagine 2024 or 2023. And let's say a recession starts in 2024. And a firm is losing money, and the CEO goes in front of shareholders and says, well, we made this major investment, debt financed, and now we're in trouble because we had no idea there was going to be a recession at the end of 2024. The reception would be totally different. The shareholders would laugh at that CEO. That CEO would be terminated. So to say that you're surprised when you've got an indicator that is screaming code red for 20 months and you ignore it, pull the trigger on a bet the farm investment for your firm? No, that's just not going to work. So that's what I call kind of the risk management impact of this idea, that it allows people to plan. And we saw this in 2023. We saw companies making these small layoffs, might be like 10% of your workforce. And they were getting ready. They said, look, there's a probability that there's going to be a recession. It might not happen, but if it does, we need to be ready. And it's way better to do this early, to lay off the 10%. Those 10% can get another job than to go in unprepared to a recession and slash 40% of your workforce. That's brutal. It's awful. Those people are very difficult to be replaced at that scale, and you put your firm at risk. So this is the sort of idea that improves economic outcomes. It improves personal outcomes also. And it's kind of interesting because yield curve today is different than when I proposed it. Because when I proposed it, it actually was, according to the theory, it's reflecting expectations of the future. Whereas today, given it's so well known, it is actually a causal mechanism. And I just described the cause. The CEO sees the yield curves inverted, that changes their behavior. They reduce investment, they get ready, they make their labor force leaner, and those actions actually slow economic growth. So it's causal in that respect. But, and this is crucial, the growth is slowed, but the firm is stronger, it's more resilient, it can survive. So you give up a little growth in the short term, but it strengthens the firm in terms of risk management to get through a potential crisis. If the crisis doesn't occur, the recession doesn't occur, fine, but
Right.
you're ready. It's risk management. So again, this is the sort of stuff that energizes me. I want to make an impact, a positive impact.
Well, I got to say it's commendable. I can feel the passion coming through. And that's what's so important when when we read a LinkedIn post, when we read a journal or even a book that you've written. That's why I love doing these interviews, because that's the part that really comes out, that shows that these words were put together by someone who actually cares. And it's interesting, your point that now it's not just becoming a leading indicator, but it's actually becoming causative, if I can use that word. It's having an impact on actually causation, which is interesting.
Yeah, so this idea of the causal mechanism, some people sometimes say that once a leading indicator becomes so well known,
Yes.
then it no longer becomes a leading indicator. And the story that I told you is actually consistent with that. So a company kind of becomes leaner, it delays some important investments, it actually slows the growth. And then when a slowdown actually occurs, they don't need to slash, as I said. And when you slash, that's very bad for the economy. It actually makes the trough even deeper. So think of this as this risk management reduces the volatility, and you're potentially able to dodge a recession. So it might be slower growth, but not a recession. So in that respect, kind of smoothing out the business cycle, that's what good risk management actually does. And this is a tool to do that. So yes, it's useful for planning, but it might in the future not be as predictive of the business cycle as in the past, because now it's actually a causal mechanism.
It's interesting. And maybe that's why you're leaning to a potential for a soft landing.
Yeah, so let me clarify what a soft landing, and you're referring to my recent LinkedIn post, and indeed
Yes.
I invite your viewers to follow me on LinkedIn. So soft landing, we talk about soft landing and hard landing, and look, all of these recessions are different. Some recessions are really brutal, like the global financial crisis, or what we had in the early 1980s. Those are really tough recessions, but we've also had these other recessions that are really mild, like 1991, 92, 2001. And indeed, some of these recessions, the year-over-year real GDP growth in the US is not even negative. So think of a recession where you don't have negative real growth year over year. So maybe you have a quarter or two that's negative, but they're classified by the National Bureau of Economic Research as recessions. So a soft landing, the way that I think about it, is either a mild recession, like 2001 or 91, or just slower growth. And my model is about predicting growth. And an inverted yield curve is very unusual, and it predicts slower growth. And some of those might be recessions, but that's just kind of the way it goes. And I will mention that, as I said, at the University of Chicago, I proposed this idea. There's 4 observations, like 4 recessions. And usually after you publish your discovery,
Yep.
2 things could happen. So the good scenario, this is the good scenario, is that the effect gets weaker through time. So that means some false signals. And the bad scenario is the effect totally goes away. And the finding you had was just lucky. So in my case, neither of those scenarios unfolded. For the next 4 business cycles, this indicator was accurate. So it is 8 out of 8 without a false signal. And the false signal is important because you could have an indicator that forecasts a recession every quarter. It will be 8 out of 8, but with a massive number of false signals. So again, this is a very simple model. I think it's useful for risk management. Of course, you need to use other information. This is just one of the inputs. It's an important input, but it's only one of the things that you should be looking at.
So I just want to take this now to the current state of where we are. The yield curves have been inverted now for 20 months, as you mentioned. And there's a lot of different ways that I've heard this quoted. Is it the 3-month and the 10 years? Is it the 2-year and the 10-year? Perhaps you could walk us through which ones the actual are the actual indicators and what they're currently telling you.
So I get this question a lot. So I chose 10-year minus 3-month. And the logic was pretty straightforward to me, that at the long end, I wanted the most liquid bond, where I didn't want a bond that had a lot of noise in it due to illiquidity. So the 10-year is obvious. I actually looked at a 5-year also, but it's almost no difference in terms of the signal. And then at the short end, I wanted something short term. And 3-month made sense because GDP is measured quarterly, 3 months. So that's short term. So my model is the 10-year yield minus the 3-month Treasury bill yield. Now, others have proposed different pieces of the yield curve. So a popular alternative is the 10-year minus the 2-year. So the way I think about it is, okay, that's a choice, but why? And usually, if you're using, let's say, the standard one that I published back in the 1980s, 10-year minus the 3-month, well, there's a good reason to replace it if, let's say, it's giving false signals. But that's not the case. There hasn't been any false signals. It hasn't missed. That's 8 out of 8. So why do you want to replace it with something else that's got a much shorter track record? You replace something when it's broken, and you need to prove to me that it's broken. I have no idea how you would prove that. So that's number one, it's like a puzzle as to why go to the 10-year minus 2-year. And then the number 2 reason is the 10-year minus 2-year has got a false signal. So that's in 1998. So it predicted a recession that never occurred. So why do you want to replace something that has got this stellar track record with no false signals, that's 8 out of 8, with something that has got a much shorter track record and a false signal? It doesn't make any sense to me. And indeed, like, how do we even think about this? That there's so many different yield spreads that you could use. So why is it the 10-year minus the 2-year? Why isn't it the 11.5-year and the 2.75-year? There's so many ways that you can data mine. And the best thing, in my opinion, is to avoid the data mining. Just take the indicator that happens to work, and it happens to work out of sample. So we've got a long, more than 30 years of out of sample evidence that this is actually working. Now, you mentioned today. So in November 22, the yield curve inverted. So my measure of the yield curve, the 10-year minus 3-month. So, so at that time, I went on the record saying code red. And given the record, this is the 9th inversion, and it would suggest that we're heading to slower growth. And the inversion is still in play today. So, so again, you need to be obviously careful given the track record of this indicator that when you get an inversion, you need to actually take notice. Now, there's a couple of additional pieces of information. So again, this is a very simple indicator. So it's just like 2 numbers, the difference between 2 numbers. And the economy is very complex. So we know it's a simple model. It is very good at giving a lead to the onset of a recession, but the lead time is variable. So it could be 6 months, it could be 2 years. So it's not consistent. Some people criticize the measure saying, oh, well, it's inconsistent in the lead time. So, well, like, I'm sorry, this is 8 out of 8, and you can't have everything for such a simple indicator. Or people might say, well, it doesn't tell us about the depth of the recession. Well, again, you can't have everything for such a simple indicator. So within the history of the 8 yield curve inversions, there are 2 things to note. Number 1, the maximum lead time in the historical data is 23 months. And right now we're at about 20. So we're not even at the historical maximum. And even if we got to the historical maximum, you might have the 9th looking different than the other 8. The second thing is more subtle, and this is very important for your viewers, that some people have said to me, well, when the yield curve uninverts, will you declare that this has been a false signal? And I said, well, actually, no, because over the last 4 recessions, the yield curve uninverted shortly before the recession began. So this is just a property of a leading indicator. You get the inversion, you get the uninversion, then the recession actually starts. So that's important to realize, and we're not uninverted yet. So the 10-year minus 2-year is pretty close to uninverting. And the 10-year minus 3-month, we'll probably have to wait until September. And that's when the Fed is likely going to cut 50 basis points. And that might be enough to cause the yield curve to uninvert. So again, this is an indicator that has been reliable. I'm very scientific about this, that I realized, given a simple indicator with 1 variable, that it's naive to think that this indicator will continue to have 100% track record. It will fail at some point. It's obvious to me. And then the media especially asked me this question, well, don't you hope that we'll have a recession so your indicator will go 9 out of 9? I tell them, uh, actually, no. So I actually hope my indicator is wrong this time, because nobody in their right mind would want a recession. A recession is bad, not just measured in dollars, but in the human stress that's caused. That's unmeasured. We talk about negative real GDP growth. Well, we don't measure stuff such as the stress that families go under when uh, when somebody is laid off within the family. You know, that's really costly. So I hope this indicator is incorrect. And I hope that if it is correct, that it will be a soft landing, as I described, either a mild recession or just slower growth until we get back to a different growth path.
Fair enough. Would the SAM rule, because that one seems to have been triggered, that's the one with the indicator that looks at unemployment. Perhaps you could give us your thoughts on that as an indicator that could be perhaps paired with yours and what you think that's telling us.
Yeah, so you have two indicators triggered right now. So inverted yield curve and this rule that's based upon unemployment growth. And it's smooth over 3 months. So this indicator is particularly useful for identifying whether you are in a recession or not. We know that employment is a coincident indicator. So this is not an indicator that is a leading indicator. The yield curve is a leading indicator. But the way it works is that sometimes you go into recession and you have no idea that you're in recession. The official dating of the recession is done by the National Bureau of Economic Research, and they will take their time. And it might be a year after the fact that they declare a peak in the business cycle. So the peak, what follows the peak is the beginning of the recession. So this indicator is very reliable at telling you whether you're actually in a recession or not. And if we literally read it, it would suggest that we are in a recession. Now, again, this indicator is a very simple indicator, and it could also be a false signal. In particular, there is a clear trend that unemployment is increasing. And this is, a lot of people maybe thought that what happened on Friday with the jobs report was overreaction to one data point. And that's incorrect. There were a series of data points over the last 6 months. And what happened on Friday was just confirming what we've seen over the last 5 months. So it was confirmatory. So it wasn't an overreaction to just a single report. That report was confirming what we've seen, and the trend is increasing unemployment. The indicator is triggered. Again, it could be a false signal, and one kind of good argument that it might be a false signal is that we started from a very low rate of unemployment. So the unemployment rate today is not historically elevated at all. And what I look at, and I think is more important than just looking at the unemployment rate, the indicator that I look at is the number of job openings divided by the unemployed. And over the last 18 months, that has decreased. So it used to be, and this is actually very good for the future, it used to be like 2 openings per unemployed.
Yeah.
And that has decreased to roughly 1 for 1, which is still very good. And what that means is that you could have an economic shock and people get laid off. But given that there's openings, those people, the duration of unemployment is low. And the way the business cycle works is that once people start to get laid off, it changes dramatically their spending. So they need to eliminate discretionary spending, and they really cut back. They have to cut back because they've been laid off. And this just feeds into slower growth. So to have this buffer where you've got these openings, I think kind of decreases the kind of downside of any slowdown. So, so if you look at the employment dynamics, uh, it looks much different than the other times that the rule has been triggered. And indeed, I'd like to see that analysis. It's not my indicator, but look at the previous triggers and look at the ratio of job openings to unemployed.
But those job openings, if you will, could evaporate in the event that there's a slowdown where a company all of a sudden decides, you know what, we're in a hiring freeze, and all those openings that they were looking for all of a sudden turn and go away. And
Yeah,
we've seen that before.
totally agree with you. And a lot of it is where you start from.
Correct.
So it could be that you start from, let's say, you've got like 0.2 openings per unemployed, and then you go into a recession, and that decreases to 0.1. And both those situations very bad. But given that we've got one opening, and and we go into a recession, maybe that's cut in half to 0.5. And 0.5 is pretty good. So I'm just saying it's not necessarily every single opening would go away because different industries are affected differently by recession. So some industries are more immune to recessions than others. So there will be openings. And just the fact that we have a high number of openings is a positive. And it's kind of consistent with the narrative of soft landing. And to be clear, soft landing is decreased economic growth, which could be a recession. So it could be like a milder recession. A hard landing is like the global financial crisis.
So in your version of what could be a soft landing, it's still it could be an economic contraction. It's just not to the extent that we had during the great financial crisis. Is that the way I should interpret that?
Exactly. So there are certain recessions, if you go back in the data, US recessions I'm talking about, that are very mild. And indeed, there are some recessions where you don't even have a year-over-year negative real growth. You've got some quarters with some negative real growth, but year-over-year is still positive. That to me is the ideal situation
Right.
where we go in, we have some slower growth for a while, and then we start back on a better path.
I want to talk through a little inflation a little bit because that is something that's you mentioned. I love how you say it's a very simplistic model, but when I think of the weather and the forecaster's ability to predict rain, they get that wrong, and they have a 50% chance of being right, and they do that often, even with 1 day advance notice. So just because something's simple and doesn't mean it's discarded. But anyway, talking through inflation, and right, we've just come off a period of very high inflation that we haven't seen during the last, let's say, 3 recession levels. And so we've seen a much bigger move in inflation. Even starting now, we're at a higher level of inflation, perhaps than we were during the financial crisis, which perhaps could change how the curve works and perhaps the impact that it has on this coming slowdown, let's call it.
Yes. So let me address multiple points that you made.
Good.
So first, I want to emphasize that my model is a simple model, and that's different than a simplistic model.
Fair.
Second, weather is really interesting. So it is it is technically the most challenging. in terms of computational power that is put to weather forecasting, it is just a dramatic difference between today's forecasting with satellite data all over the world and these really complex models and and the past. And we really see this in kind of hurricane data, where mortality is dramatically decreased because of advanced warning communication and stuff like that. So those models are really super complex. You need supercomputers to run these models. My model, which is a simple model, is just a single variable. So it's nothing like that. But the difference is that my model has the ability to look to the long term. The weather forecaster, you can do a great job of forecasting the next 5 minutes, but to forecast the next year, very, very difficult. So that said, let's switch to inflation. So inflation is fairly complex for a number of reasons. And we could do a whole show just talking about inflation. So if you need to take quality into account, and that's really difficult to do. But we saw an inflation surge, and it was kind of obvious that it was coming. You had this unprecedented stimulus, both fiscally and on the monetary side. And when you send people money, goes into their savings account, that's going to be spent. And it was no surprise that there was going to be a surge. And indeed, it's fairly easy to forecast the CPI. And let me tell you the reason why. One important component of CPI is shelter. And that's 36% of the CPI. It's the most important component. And the way that shelter is constructed, they use a concept called owner's equivalent rent. And it turns out that when you use this concept, it induces a lag. So, and the lag is quite a reasonable lag. And it's actually, it's reflecting sort of real-time experiences of people. And let me give an example. And it's a simple example of rents. So let's say December 31st, your landlord sends a letter out to all tenants saying, next year rents are going to go up by 10%. So if your lease expires December 31st, then your rent is going to go up by 10%. If your lease expires October, then you don't experience that increase until you renegotiate and re-sign your lease at the end of October. So you see that that in real time, the person that's got the lease that doesn't expire till October, they're not experiencing any inflation, but they will. Okay, so in that sense, the inflation actually was set in stone December 31st, but doesn't make it into the data until later. So when we see real-time rents jump, as we did in 2020 and 2021, by double digits, then we know that that will eventually make its way into the inflation rate. So it was obvious to me in 2021 when the most important component, when I was observing 10 to 14% year over year rent increases in real time, and then what was being recorded in the CPI year over year was like 2% or 3%. Well, I knew that that was going to change.
Right.
And we were going to surge. The Fed at the time apparently didn't understand this mechanism or chose to ignore it and said, well, inflation is transitory. And it was inexplicable to me. So no, it's not transitory. This will make its way in. And if you look on my LinkedIn historical posts, analysis of this. You can eyeball it. It's obvious, eyeballing the data, that this lag is there. So it was clear that inflation was going to surge. And then over the last year and a half, if you look at the real-time rents, and what I mean by real time is if you moved and took out a new rent, how much would that cost? And if you look at the data today, the rent year over year is essentially zero. Yet what is going into the CPI is more than 5%. So what's going into the CPI is completely disconnected from what we observe in real time. It is, and again, it's subtle but important. It is the experience of people. But what the point I've made many times is that the Fed needs to look at the real-time inflation, which is constructed with real-time rent, because their policies can do nothing to change what's already happened in the past. So that landlord that December 31st sent out the 10% rent increase, that is history. That's gone. And they cannot control that. That will work its way into inflation. The Fed can do nothing about that. They can only affect stuff going forward. So what they need to do is, instead of using the official CPI, they need to replace the shelter component with real-time inflation for policy purposes. So for making policies that affect today and the future. You can leave the CPI as it is because it does reflect the experience of people, but it is a fundamental policy error to develop a strategy based upon stale data.
And so, in your mind, right now, the Fed is using stale data. You pointed out in your posts that inflation, this adjusted, can I call it an adjusted number, or calculated with the more up-to-date input, inflation is actually running below 2%. And therefore, the Fed should have acted probably in January, as you pointed out in one of your posts, I think. And so, are you suggesting that if you were Powell come September, what would you be doing?
So I want to clarify something that's important. So yes, the Fed should have been cutting, but the cut is to undo the mistakes of 2023. So they overshot. So they went way beyond where they should have gone in terms of the short-term rate. And the cut is only to undo the damage. So the Fed historically has done a lot of damage.
Yep.
Think about the extended period of zero interest rates. That was not helpful. That was distortionary. How can you have a zero interest rate when unemployment's low, economic growth is robust, stock market's at all-time high? There's just no reason to actually have that. So a number of mistakes here. And
plus, there's QE going on at the same time.
Yeah, so really kind of what I'm doing is advocating that they undo some of the mistakes.
But don't those mistakes that we speak about now, don't those have longer term implications? And I think this might, where I want to, because I know time is tight here, I want to take this to, therefore, on the call, the vast majority are portfolio managers or those working in portfolio management. I know you actually have a survey that you do of portfolio managers, which I find very interesting. So perhaps you could share some of what you're hearing during your surveys, along with what you're seeing in the trends, and suggest, therefore, what should we be thinking about in terms of asset allocation, et cetera.
Yeah, so the survey that I've done for the last 25 years is the Duke CFO survey. This is the sort of information that's forward-looking. The survey was recently taken over, not completely, or shared by the Fed, because they realized, they did the analysis. They realized that the sort of leading indicators they were getting were things like purchasing manager survey. And what we were doing is talking to CFOs, and CFOs know well ahead of the purchasing manager. They're giving the purchasing manager the orders.
Right.
So this is a forward-looking indicator. And again, we talked about the yield curve extensively. It's a forward-leading indicator. Expectations of CFOs or asset managers, that's forward-looking. That's the sort of data that's really important. And it's kind of consistent with what I was saying on shelter inflation. You want to look at real-time data, not stale data. So if you're going to be forecasting GDP, you need to have a series of indicators. If I was back at Falconbridge Copper with the same task, given what I know, that I would look at the yield curve, but I would look at like a half a dozen other indicators. That's really important. So you're asking me what I think is going to happen in the future. I cannot give direct investment advice, especially over, like a show. I definitely don't do that. I don't even do it in my classroom. But this is the way that I see this playing out. So I believe that there is a lot of risk right now, but the economic fundamentals are different than, let's say, 2007, where there was a lot of leverage. So banks were hugely levered. Consumers were levered, having almost no equity in their housing stock. And we don't have that today. So I think that that's not going to make things worse if there is a slowdown. So I think that the hard landing scenario is lower probability, though the Fed's actions have dramatically increased the chance of a hard landing. So that's unfortunate, but the odds are still for a soft landing. So I see over the next, let's say, year and a half, the growth will slow. There's other reasons to believe the growth will slow. For example, in the US, consumers have run down these COVID era stimulus-based savings. So 2023 consumption growth was driven by consumers drawing down their savings. The savings rate is now well below pre-COVID levels. We see increases in delinquencies on consumer loans, whether it's autos or credit cards. That's in the data. That is forward-looking. That is saying that consumption spending will be weaker in the future. So I see a slowing growth and then a recovery, and actually think that there's a number of items that kind of are encouraging for future economic growth. And you mentioned right at the very beginning, decentralized technologies and artificial intelligence. I think this is a really, really big deal that is being underestimated. Economists are saying, oh, well, this isn't that important. It'll contribute a few basis points to productivity. I have a completely different view of this, that this is a massive innovation, this combination of decentralized technologies that make everything just more efficient, reducing costs, increasing security, maximum transparency, coupled with artificial intelligence. I think we could see a real boom, an unexpected boom, but a much needed boom in real activity. So we're in a kind of an awkward situation where the US in particular has a very large amount of debt, 9 trillion in deficits alone in the last 4 years.
Yep.
And the interest on the debt is right now the second largest spending category, much more than national defense.
Yep.
So 36% of all personal tax is used in the US just to pay the interest. So how do we get rid of that? Well, if you increase taxes, that's toxic for growth, and no politician wants to do that. You could print money, but that just causes inflation, and nobody wants to do that either. The third way is the most attractive way, and that is to grow. And we need robust growth. And I do believe that we have, given this dual technological innovation, the chance to actually pull that off. In the past, we've had 5% real GDP growth, and we seem to be settling for something in the range of 1 to 2%. That's not good enough. That's not going to deal with the national debt or the deficit. When you have growth, it just naturally increases the tax revenue. So with the same rate, if people making more money, then more tax revenue actually comes in. So I've actually got a positive outlook, beyond this short-term period where we'll have slower growth.
You're not concerned. I know we don't have a lot of time left, but to unpack the DeFi point and as well AI, I mean, we've seen what happened with FTX. There's concern about, that you mentioned transparency. Well, there is anonymity that happens in transactions that can cause problems. And anyway, I'll leave it at that. There's been, there's a number of studies that have been done that suggest that the amount of spending that we've already had on AI is already reflective of potentially a bubble. I lived through what was the fiber bubble of the early 2000s and started my career just before then. So I saw what that was like. So I'm wondering, and to me, I get lots of senses that it's similar.
So let me say a few things. So
Sure.
Number one, FTX is not DeFi. FTX is a centralized company that happened to be trading cryptocurrencies. It's just a straight up fraud. So that is not what I'm talking about. I'm talking about ways to do transactions securely at very low cost, ways to take out the middle person to reduce costs, where we trade something and at the point of trade, at the point of execution, you settle. You don't need to wait a day or two. You don't need to wait 2 to 5 days for a transfer. And this allows us to monetize a lot of unused resources. So think of your computer. How much of the CPU or GPU do you use in a day? It's trivial, it just sits there. You've got all this excess capacity. So why not rent it out overnight? Let's say you rent it out and you get paid. You get paid in a token and you accumulate that. Or you rent out your disk space or some of it and you get paid. And this is a dramatic change. Or you're on social media and you view an ad, you get paid for that. So right now we have a very bad business model where people put their data up and then it's just sold to advertisers and they get nothing from it. So this is really transformative in terms of what consumers will actually get. So this is a technology, I call it decentralized technologies, that affect not just the narrow space of crypto, it affects all companies. And all major companies have teams working on this technology. It's under the radar largely, but it is a big deal. Then you couple this with AI, I see a lot of growth potential. But your point is a good point, and that is there are risks. And with any major technological innovation, there are risks. If you want to go risk-free, then you kill the innovation. And we know that from finance. You want to reduce all your risk? Fine, just buy treasury bills. And you need to settle for the return on treasury bills. So I think of finance and economic growth in kind of the same way, that you need to take some risk to get the high expected returns. And I think we're on that path, and I hope we do not fumble. because it is a historic opportunity when you've got two innovations going on at the same time.
But it is going to need some significant regulation.
Again, we need to be careful about the regulation. So yes, we need some regulation, but if the regulation is too onerous, then you drive the innovation offshore. And this is a global technology, and no country wants to lose their best ideas. So the regulators need to be smart about this. You cannot eliminate all risk. Again, eliminate all risk, then just buy treasury bills.
Last question I always like to ask my guests, two quick things. Your favorite book that you think you want to pass on, and your favorite breakfast.
Oh, okay. So my favorite breakfast. Currently, I have kind of a gluten-free muesli in the morning,
Okay.
and a decaf coffee. That's my breakfast. And I'll tell you the book I'm reading right now, and that's Neil Ferguson's the Square and the Tower, and it's a book about networking. And he is an economic historian, and I would highly recommend this book. It gives a good history of the importance of networks and kind of the economy.
All right. We'll leave it at that. Thank you for your time, Cam. I wish you all the best, and we are going to have to check back in on you with you in the next few months.
Very good. Great talking to you, Anthony.
Thank you.